Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Tuesday afternoon webcast. Joining me today is David Burrows, our Chief Investment Strategist and Portfolio Manager here at Barometer. And today we're going to be talking about how Barometer has been interpreting this new infrastructure bill and David, of course, will provide us with a brief macro overview as always. If you have questions, we will be pleased to address them at the tail end of this conversation. You can email me at phastings@barometercapital.ca or send me the question via the Zoom chat. And with that, I turn the conversation over to David Burrows, who is in our headquarters in downtown Toronto. David, it's such a pleasure to see you this afternoon.
Pamela, nice to see you too. Even though we haven't seen each other face to face, you are here back in Toronto. It's good to see you. And I'm in downtown steamy Toronto, back at the office. Kind of nice to be back here. With all of our bells and whistles. What I thought I'd do today is just quickly kind of review what's been going on over the last short while. We have had a thesis that after some consolidation, we'd see a reacceleration in the reflation trade or the cyclicals or the economically sensitive parts of the market. It appears to be playing out. We're going to talk about some of the internal breadth readings that we see and some of the changes there and some of the data over the course of the week. So Pam, thanks so much for kicking this off, and thanks everybody for joining us today. Just quickly, starting from the top, as always, we have a big belief that as investment managers, you can have a little bit of money everywhere and get diversification and try and take risk out that way. Or on the other hand, you can try and understand the big structural themes or the backdrop to the current market and build portfolios that reflect that. And recognize that, the hardest thing to do in a bull market is to stay in your winning positions. There's constant reasons why maybe is going to get to a short-term top or the theme's going to change. Second, in a bear market, your most difficult thing to do is to be a good seller. And so right now we're in one of those times when it's important to hold your winning positions. And we're going to kind of talk through that a little bit. So the structural backdrop to the equity market is that we started a new structural bull market in 2013 when we exceeded the bull market highs from 2000. So exiting a 13-year bear market. And we're now sort of 7 years into what tends to be, 15, 18 years in a structural bull market. Last one went 1981 through 2000, the one prior to that, 1951 through 1966. So, these do go on way longer than people think. We also have had a belief that after a very long period of disinflation and falling long-term interest rates, we're likely going through a bottoming process over the last 2-3 years. And that has important implications as to what weight might work going forward. What certainly worked between 1951 and 1981 is very different than the things that worked in the period from 1981 through 2016, 17. So what works well in falling rates tends to be quite more defensive positions, things that are long cycle like secular growth stocks that have predictable earnings growth. What works well in rising rates tends to be things that have a shorter cycle in their business, like financials or industrials. Dividend growth tends to outperform defensive dividend stocks. And so important to kind of follow along those lines to see that these things are actually happening. We also think that we've been going through a structural bottoming in commodity prices. And certainly this is a very unpopular part of the market. It doesn't fit ESG well. But they're important building blocks of the global economy. And notwithstanding what happens in North America, the rest of the world needs to build infrastructure. And certainly the US is embarking on some new infrastructure plans. So it could be a very important part of the market. Just examining the S&P sort of under a microscope from last fall, following sort of the September, October consolidation range, we've been in this channel, which is very consistent now since last November. We've touched on the lower bound several times. We've touched on the upper bound a couple of times. And recently, after trading sideways for a couple of weeks, sort of coming out of that range to the upside. This is the Nasdaq 100. Of course, Nasdaq 100 had its period of consolidation kind of between March and June. And then in June broke out when some of the large cap tech stocks reaccelerated. Good to see, another group heard from. S&P 500 in the channel, moving a little higher into the recent consolidation. Nasdaq 100, after consolidating kind of February through June, reaccelerated. The TSX is actually making relative new highs versus the S&P. That's important because it is a little bit more cyclical market, and it's our home market, can be very important. There's the equally weighted S&P. So this takes out the impact of market cap weighting, or the very largest cap stocks dominating the index. This is the average stock in the S&P 500, each one worth the same. Again, consolidated sideways. Now, this could have gone either way. We could have broken down. We could have corrected. If there was some real concern about Delta variant and it becoming a bigger issue, then certainly this is something that there we go. This would have been somewhere where it would have shown up. And then we use the NYA, which is the New York Composite, again, taking all stocks in the NYSE, same thing, coming out of this consolidation range. So all these things were quite important to see an improvement to show that this rally was on its way higher. So let's keep going. About 2 weeks ago, we put this slide up, which was our breadth readings for global markets. So this takes a measurement of the percentage of stocks within the global markets, the NYSE and the Canadian market, that are in uptrends. And we know that a consolidating or correcting market can see a percentage of the stocks that have been in uptrends start to back off and break down. When we see our readings start to weaken, it causes us to be a little bit more cautious, to stop putting on new positions, to tighten up the stop losses that we have to protect against declines. And then if our positions hang on, or turn around, start to rally, or if the breadth starts to improve, again, we believe that the wind is at our back. So as we sit today, virtually all of our short-term indicators have gone back to positive. Our US indicators have gone back to positive, meaning breadth is expanding. World bullish percent, or the percent of stocks in uptrend, is a whisper away from reversing up, as is the Canadian bullish percent. So certainly we've seen improvement in breadth, and that's important because there's no bear market or major correction in history that took place while breadth was expanding. It's kind of like an all green system that points to more positive outcomes. When we look at internally in the market, in the NYSE, we know that between October of last year, where 86% of stocks had upward trajectory or momentum, we got as low in the beginning of July as 24%, meaning 75% were sort of in a lull. And importantly, over the last couple of weeks, we've seen a re-acceleration in momentum underneath the surface, which means that things are broadening. It means that there's buying power, and it means that we have the wind at our back. So let's go back and touch on our leadership themes as it relates to these points, okay? So starting out with some basic backdrop, US financial conditions. We pointed out last week that US financial conditions were the easiest on record, meaning that money was more available than at any time in history. We know the Fed has been printing. We know that the government has been implementing fiscal policy. There's lots of liquidity. The old saying, don't fight the Fed, is something you should never, ever forget. It's very hard to have a very weak market without tightening financial conditions. We talked last week also about the fact that inventories were at multi-year lows. Okay, so this goes back to 2011, and 50 is the point at which there is neither build or decline in inventories. We've seen a steady decline in inventories over the last 18 months. And what that means is at an even consumption, you're going to have to see inventory rebuild take place in the system. And so that, again, is an important backdrop for these markets, because we want to see the cyclical industries continue to show good earnings growth, continue to show good earnings revisions. And that's what's been happening. We talked last week about the fact that beginning of July, earnings estimates for S&P 500 companies are $45 a share. That's a composite of all of the earnings in the S&P. By the end of July, the estimate was $51. For the third quarter, estimate at the beginning of July had been $47, it was $49 by the end of the month. So we're seeing revisions go higher. Well, now let's continue to go down that path, because this week, we hit a new high in the percentage of upward earnings estimate revisions. Of all of the revisions over the last 3 months, 73% of them have been upward revisions. Now, this is important because what generally drives third quarter weakness, August, September, October, which we've often seen in the past, is that analysts come out of the year, out of the blocks with an optimistic view that things will get better over the course of the year. And by August, if things aren't living up to their expectations, they start to ratchet back their expectations. So as we sit today, we're seeing an acceleration in earnings revisions higher, not lower, which certainly is supportive because at the end of the day, earnings drive share price along with multiples and financial conditions. So let's look at some of the important things that we look at. We talked about bond prices and how they have been consolidating. This is U.S. short-term bonds. We've seen bond prices on the back of economic strength start to weaken again. One of the big concerns last week was the fact that the 30-year Treasury bond or the 10-year Treasury bond had gone back to 1.13% yield. And was that signaling some kind of a slowdown? So if we look at the TLT, you can see the TLT, after declining significantly, that's the U.S. long bond price, rallied and consolidated in this range, put in a rally high early July, retested that high a few days ago, and has been selling off since. So like the cyclical stocks re-accelerating, it looks like the bond market may be rolling over again or yields starting to head higher, reflecting some of these growth characteristics. So let's talk about the leadership themes and the things that may be driving things. As you may know, the Senate passed today their version of an infrastructure bill, approximately $1 trillion of spending for things like roads and bridges and broadband internet access. There is a companion bill that is also a similar dollar value that they're trying to pass on some other soft infrastructure issues. Obviously, still some hoops to go through, but the market is sitting up and taking notice. This is the long-term price chart of the Rogers Commodity Index we highlighted at the end of last year. It broke the downtrend that had been in place since 2008. We've actually spent the last almost 9 weeks consolidating sideways. These are monthly bars. But when we look at what's happening under the surface, things are getting better. We highlighted 2 weeks ago, that 57% of all of the materials sector stocks hit a 3-month low. In other words, a consolidation low. We thought that was reflective of correction and consolidation, and likely we would start to see re-acceleration shortly. So here's what's happened. This is the XLB ETF, which is the makeup of the S&P Materials Index, after consolidating for roughly 90 days. About 10 days ago, broke out of that range and has now started a new leg higher. You're going to see a lot of these look the same. This is the XME ETF. This is the miners ETF. This takes a look at all of the base metals miners, along with the gold and silver miners. There's the steel index, a very similar picture, consolidation, move out, consolidation, and today having a very, very good day on the back of some of this infrastructure news. This is the rare earths ETF. Now, some materials obviously have different supply-demand metrics, and some better, some worse. Rare earths are very short supply and dominated by companies outside of the US, although there is some move capacity into the US. This is some of the companies that we own. Freeport-McMoRan, copper and gold, after consolidating, came out of that consolidation to the upside. And one of the companies that actually is hitting new all-time highs is Ivanhoe Mines, which is a variety of base metals on our Canadian exchange. Agriculture coming out of consolidation to the upside, led by Nutrien. Nutrien, one of our big holdings, obviously in the fertilizer space, and also retail for agricultural supplies, had a very, very good day on raising their estimates going forward, coming out of their earnings period. And the GLD, gold, continues to consolidate, although I think structurally still looks very, very good after almost a year of consolidation. Our late major holding here would be Franco-Nevada. And Franco is probably a lower risk way of having exposure to precious metals because they get the royalties on the production of a whole host of mines and pays a nice rising dividend stream. Let's move away from materials. We're going to stay in the cyclicals camp. We also talked about the fact a couple of weeks ago, financials, 51% of stocks were hitting a 3-month low, again, reflective of what happened sort of in a corrective period, not so much a bear market. And what's happened since? Well, we've seen a reacceleration. This is the XLF ETF, again, moving out of that bullish flag. And this is the last 2 weeks of action, back to the highs. And again, looking like it's prepared to start its next leg higher. Now, we know there's lots of things that are getting better. With the bond yields starting to move higher again, that's a good thing for the financials. Also, we got some data out of the Senior Loan Officer Survey that percent of banks reporting strong demand for loans was really improving. And so when we look under the surface there, we said the leadership is in the investment banks and asset managers. Hard to see this group do well if people think there's a significant correction coming. They've really accelerated over the last 2 weeks under that consolidation. Our big weights here are Goldman Sachs, which is best of breed, and Morgan Stanley. Both are making new all-time highs today. So also in this group, though, asset managers. And we talked a little bit about CI Financial and some of the efficiencies that they've been getting in restructuring their business, some of the direction that they've been taking in purchasing US wealth management firms. They announced another wealth management purchase today, but again, broke out of a long downtrend going back to 2015 and now heading higher. Looks like a new leg for this one. And outside of banks and asset managers, digital payments continue to be really interesting to us. We own a company called Nuvei Corporation. They do payment solutions for gaming, for some of the cryptocurrency sites, and they just blew the doors off their earnings today and raised their estimates. Stock was up 16% earlier in the day. Let's move away from financials to consumer discretionary, another more cyclical group. Discretionary, of course, means people have a choice to spend or not. And after seeing this sector consolidate over the last 3 months, coming out to the upside, certainly there have been strong companies, even though the group was consolidating. Target is one of our big holdings. Costco is another large holding of ours. These two have really been outperforming the group. And even the electric vehicles subsector has started to move away from this consolidation rate. So there is a pretty consistent message here, and that is that things that are tied to the economy are showing newfound strength after having about a 90-day rest. And, you know, a 90-day rest would be a typical correction or consolidation. Get into industrials. Industrials, again, corrected about 96 days. Today came out of the top end of the range. We talked last week about how it was important to see that group start to perform. And our biggest weight in that group is Textron. Of course, it's a multifaceted industrial company. Okay, continuing on. Technology has been participating. Google has been doing quite well. Microsoft doing well. Apple doing well. What I care more about right now are the more cyclical parts of technology, the parts that have some pricing power when demand picks up. We know that semiconductors have been through a correction following a period where, you know, supply has been difficult. I think a lot of people took down some exposure in this group, but we've seen a nice reacceleration in the most cyclical part of technology. We talked last week about advanced micro devices. Of course, the leader always breaks out before the group does, and certainly it did. And this week, we'll talk a little bit about SiTime, S-I-T-M. SiTime is a company that specializes in making timing chips that operate in extreme conditions. Apple would be about 30% of their business. Their chips go into Apple AirPods, for instance. And again, after coming off a period of consolidation, really reaccelerating the upside, it's exactly what a leader should do. Just touching on that, going back to the way we look at the world, we want to own groups that go through periods of correction or consolidation, show new acceleration, and then we want to make sure we are in the companies that have outperformed the group during the period of consolidation or have come out of consolidation earlier than the rest. Similarly, when we see a group start to lose momentum, we want to make sure our companies are the ones that hold on longer. And if they don't, of course, we use our stop losses to move ourselves away. Moving along outside the US, we talked about how Europe has more exposure to financials and industrials. You can understand why. We broke out of a range that we've been in for several years. The European market moved higher, had its first major correction back to the 150-day, and is now reaccelerating to the upside. So put all of that together. This is the Mtum ETF. It is invested in companies that are quantitatively show positive momentum versus the market. In May, we said this ETF is going to be reconstituted from previous leadership, which was dominated by technology, to companies and sectors that have not been part of the momentum part of the market for a long time, and that includes industrials, basic materials, and financials. After eventually breaking out of this range, we are seeing a nice acceleration upward, which tells me that our leadership groups probably are in the right spot. So a few pieces of data this week to support what's going on. Employment grew sharply last week. We're not back to pre-pandemic levels, but certainly regaining altitude. The unemployment rate took another good dip lower. Employment came in much better than expected. On the PMI data, which looks at purchasing managers' intentions, we know that almost all countries are trading above the 50 line, which means they are in expansion mode. The one we're watching closely is China, of course, because China is very important to the global economy. But you can see not only growing, but accelerating. Most importantly, US ISM data, that's US Chicago data. Germany also looking quite good, and India looking excellent. Last few points. Volatility. Volatility continues to wane. We've seen a number of small spikes since last spring. Each spike has been to a lower level. Expectation for volatility remains quite low. And I really like this data point. When we talk about sources of demand for stocks, retail or individual investors are important, institutions are important, pension funds are more important. The most important source of demand for equities is corporations buying back their own shares. And through July, we have close to record intention to buy back shares. Now that's important because as we're completing the second quarter earnings period and the reporting period, companies put their data into the market as to how they did from an earnings perspective. They no longer have information that other investors don't have, so they can reinitiate their buybacks. And over the next couple of weeks, we should see an acceleration in corporate buybacks of their own shares. So we think we have three basic jobs to provide our clients with value, okay? Our job is to use the tools that we have, in this case, the breadth work that we do, the leadership that we do, to make sure our portfolios are concentrated in areas of market leadership. We're always watching for new leadership to emerge. In the current case, what we're seeing is a broadening of the market and more groups participating. So we don't need to be as particularly skewed in a small number of sectors. And we watch for signs of deterioration in breadth, which would cause us to get more defensive because, frankly, you know, our clients' biggest fear is losing a big chunk of their portfolio in a market sell-off. Now, it's not the first 3-4 weeks of a sell-off that are going to get you. It's being wrong in a bear market for 3, 4, 6, 8 months. And using a disciplined selling strategy and using our breadth-based models to gauge demand help us to tune and manage the portfolios in a tactical way. As it sits right now, the portfolios continue to be more skewed to sort of cyclical areas. Financials would be our biggest overweight in the market. We think the risk reward is excellent. The dividend growth going forward is going to be excellent. And a steepening of the yield curve and improving economic conditions will really help the financial services sector. Technology continues to be an underweight for us, although we are focused more in more cyclical technology companies. Industrials continue to be an overweight, certainly, but because other groups are acting a little bit better, we've got a little bit more real estate. We had one of our real estate positions bought out this week. Utilities continue to be a relatively small part of the portfolio, but some of the more growthy utilities like Nextera continue to act well. Consumer staples are about an equal weight. Materials are about a double weight, market weight. We have a lower weight in some of the most defensive parts of the market. I know that the concern is that the market has been doing well for quite some time. I showed those market charts for the last year and the channels that we've been in. But it's not uncommon in a structural bull market to go a long period of time without corrections. I know it is somewhat nerving when markets just march along without volatility because people hold their breath waiting for it. But look, you have to take advantage of a bull market. If we go backward into the early part of our bull market, 2016-17, we went 404 days without a 5% correction. In the 1990s, we went 394 days and 370 days without a 5%. That's more than double the length of time that we've gone currently. In the 1960s structural bull market, you went almost 400 days without a 5% correction, and all kinds of periods in between above where we are now. So we watch every day for signs of weakness. We watch every day for reasons to get more defensive. And we're very happy to do it when the time comes. That's been our history. We get defensive in a tough market. But as it sits right now, it's steady as she goes. We're making small adjustments week by week. But it looks as though we are in a market that will benefit companies with more economic sensitivity, that benefit from the business cycle, and we are in a reflationary environment. With that, Pam, I'm happy to take any questions that there might be.
Thanks so much, Dave. Well, you can tell we really are truly in the middle of the summer. We do not have any questions right now, but actually I'm just getting something live as we speak. So here's one question.
Yep.
Has David moved into and out of copper and steel iron stocks in the last couple of months as the price of base metals has fluctuated?
Okay, well, let's just take a look at that. See if I can share. Okay, so sometimes things consolidate, sometimes things correct. And so, for instance, if we take a look at the steel group, you know, it certainly corrected. It never broke down, stayed well above the 150-day moving average, well above a rising 200-day moving average. So we don't have a problem having some exposure here. Cleveland Cliffs is one I think that looks quite good. So we would continue to be there. In the base metals miners, similarly, we saw correction in Freeport. You know, we continue to be there. We saw correction in Ivanhoe. We continue to be there. So certainly we took some exposure down when they corrected. But certainly we maintain some exposure, and as we're in a new leg, we would be inclined to continue to add to the group.
Dave, really quickly, your thoughts on Bitcoin and how you or our desk is looking at playing it?
Great question. So as far as Bitcoin goes, we had a wonderful run in Bitcoin, but as we talked about in one of our early spring videos, really the trend was waning, and we stopped our way out with great gains. We had entered, I think, back in November. So we had a great run in the QBTC, which is a closed-end fund that trades in Toronto holding Bitcoin. QETH, which is the Ether ETF. I'm actually more positively disposed to Ether, and it certainly corrected as well from May through July. But about the same time as the cyclical stocks started to reaccelerate, certainly Ether did as well. So we have about a 7% weight actually in our global macro portfolio. It didn't start that way, closer to sort of 4. But again, we bought Ether back in November at considerably lower prices. So, you know, it's interesting. I mean, this is a group that does have broad support in a multi-asset portfolio like our macro portfolio. You know, this makes sense to have some exposure. And, you know, the QETH is traded from 1,800 to 3,100 in only about a month. So I think that Ether is probably more interesting to Bitcoin, but both seem to be healing after correcting.
Thanks so much, Dave. The final question today is regarding energy, and specifically how we like to look at energy. Do we prefer to focus on more traditional names, or do we take the time to look at emerging names that also have a renewable angle on them?
Yeah, so I mean, look, at energy is such a ubiquitous term. You know, this is a long run picture of the Canadian Energy Index. See if I can make it seeable on the screen. There we go. So, you know, really correcting since 2008. If we take the US, you know, carbon producers, US carbon producers also had, you know, pretty steep decline from 2014 on, and maybe have moved out of that. Certainly, when we look at it, there's the natural gas companies. Natural gas has certainly been acting very, very well. And we have exposure here to companies like Tourmaline in Canada. So we are in some traditional energy, but we're also, you know, in some new technology, right? In our macro portfolio, we have a 5% weight in the lithium and battery tech ETF. That certainly looks interesting. We have a small weight in the solar ETF, which again has gone through correction, but over time, you know, has been a very, very strong performer and came back into the moving averages. So we just recently repositioned a small weight here. We own an ETF that is a clean energy ETF. So I think we have to look at all things. When we look at the utilities, our biggest weight in utilities, even though we don't have a lot, is NextEra. NextEra, NEE. And NextEra over time has just been a star performer, probably the fastest growing utility in the US, and they have the largest percentage of renewables. So we're big believers, as you know, in investing in structural themes. And structural themes have corrections and then reaccelerate. And so, you know, solar had a good sized correction, lithium had a good sized correction, and seem to be reaccelerating. So if we get stopped out and things reset, start to work again, then we look at rebuilding weightings.
Well, thanks so much, Dave. That concludes our questions for today. I'll leave you with the final word as always.
Look, you know, we're in the middle of summer. People are distracted. We aren't. We're very focused. You know, our morning meeting every day continues to be very animated and full of discussion. We, like everybody, always worry about downside and always worried about risks. We spend a lot of time focusing on things like COVID and Delta variant and all of those things. But remember, the market is a big machine and there's a lot of moving parts. And when there's extreme liquidity and there's reacceleration in the economy, you can offset lots of concerns. So the way I see it is it's not for us to say what the market should do, it's to understand what it is doing. And the most economically sensitive parts of the market are showing reacceleration, which tells me that while we are concerned about Delta variant and COVID, there are a lot of drivers moving this group ahead, and probably not the least of which is that the economically sensitive groups are the most under-owned parts of the market. Whereas on the other side, the large cap technology stocks are owned by everyone. So we like to go to where the puck is going to go. And I think that the economically sensitive stocks are that group. So thanks everyone for joining. And if you've got more questions, don't hesitate to get in touch with us. We're happy to answer them one-on-one. And we'll be back again next Tuesday at 4 o'clock. Thanks, Pam.
Thanks so much, Dave. Thanks, everyone. Have a good afternoon.